world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're thrilled to be joined by Nektarios Liolios. Nektarios is CEO and co-founder of Startupbootcamp Fintech and Startupbootcamp Insuretech, the leading innovation programs in the financial and insurance industries. The programs provide funding, mentorship, and office space in the heart of London, Singapore, and New York, along with access to a global network of investors and VCs for up to 10 selected fintech startups per class. Nektarios has spent nearly 20 years in the business, previously with Clearstream and Swift, where he ran the InnoTribe Startup Challenge. Today's conversation with Nektarios was a fascinating discussion about a number of approaches to partnership between incumbents and startups. Regardless of the strategy used, there are a few key elements that enable successful collaboration. If you enjoyed today's show, please leave us a review on iTunes or your podcast platform of choice. As always, connect with us on Twitter, Facebook, LinkedIn, or on our website at bankingthefuture.com. Thanks so much for listening today. Please welcome Nektarios Liolios. Nektarios, welcome to Rebank.
Hello, good to be here.
You have extensive experience supporting incumbent organizations in their engagement of startups. You were present early on at one of the financial services industry's most recognized corporate accelerators, Swift's InnoTribe. Can you describe that program for those who aren't familiar with it?
Again, maybe I'll do this best by saying that it wasn't an accelerator. InnoTribe was something very ambitious, very big. Post global financial crisis, the CEO at that time, Lazaro Campos, allowed this team to emerge within Swift that was tasked to talk to Swift's members. So bearing in mind that Swift is a cooperative, it's not for profit, so Swift's member community are all the financial institutions in the world, really. And the idea was that as a cooperative, we had this responsibility to go out and educate people about what's happening in the outside world, tell them about the technology changes, talk to them about innovation in a different context. And we had the freedom and the budget to do what we wanted. So it was great. It was very ambitious, it was very free, and it was very non-corporate in the best possible sense. And I joined InnoTribe because one of my colleagues, Matteo, who now is also doing great things, he called me and said, look, we were looking to build an incubator. Do you want to come and join us? The great thing about InnoTribe was that it also looked at internal innovation and organizational change and motivating people by allowing them to do the things that they're good at. So we were talking about also finding ways of attracting entrepreneurs to actually come to us, because we, at Swift, had good access to the innovation people within the banks, but we didn't really know the startups. So we looked around and we saw that what do people do to get startups to come to them? And we saw that people run competitions. Hey, we should run a competition. So we started off with an experiment, which was the InnoTribe Startup Competition. And as we were talking about this, I thought, hey, I think I can do this. So I just stepped up and took it over, what was a nascent experiment, and built it into a global process with showcases in London, Singapore, and New York. And this is how we managed to see some really interesting startups at a very early stage of their journey around the world, and before the term fintech became a term. So we didn't even have a word for it at that moment. And as part of that journey, we saw some companies that are now kind of household names, like an Asimo or Cantox or Open Gamma, who are now in the press because of the RegTech angle. And TransferWise, for me, TransferWise is always the best story, because TransferWise made it into our finals in Toronto in 2011, and they didn't win. And they were not particularly happy about it.
Who won?
You know what? I don't even remember. That's the whole point, right? But the good thing about that was that we really got close to really great startups really, really early on.
So you used the term incubator at one point.
Yeah.
How would you describe InnoTribe?
InnoTribe was an innovation initiative.
Okay.
It did multiple things. We had an internal incubator where we could play around with ideas. We had the startup competition, which was all about engagement. We had the conference piece, which is still around, which is InnoTribe at Cybos, which was us finding really cutting edge technology players and the big thinkers and inviting them to talk to the industry about what's happening. So we talked about Bitcoin and blockchain way before anybody else. We talked about big data before it became commonplace. So this was our vehicle and still does, right? The interesting thing is the first session we had about Bitcoin attracted, 100 people. Last year, there was a blockchain session at InnoTribe at Cybos, where they needed an overflow room because the room was so packed that, they needed to find a solution. So it did do the right things at the right time. What happened, though, is that because of leadership changes in the company, but also because of a lack of recognition of the value that Swift provided to the community, we, little by little, as it always happens, our budget was eroded. We were much more restricted in what we could do. And most of the people in the team left within the space of 4 months. Now, we had started talking to various people in the ecosystem about us running an accelerator. So we recognize that we have got access to great startups, but we only have this very light engagement through the competition. So what can we do to get closer to them? And we looked around and we saw Startupbootcamp as being an organization that had a similar spirit. It was very much community driven. It was European. And we thought they don't do anything that is fintech focused, that is not industry specific. Maybe we should start talking and then we can run an InnoTribe Accelerator, an InnoTribe Bootcamp powered by Startupbootcamp. And as all these changes were happening within Swift and InnoTribe, it was just the logical thing for me to leave Swift and do Startupbootcamp fintech anyway, but from the other side. So this is how I ended up at the end of 2013, looking at myself and realizing that I think I'm about to become an entrepreneur.
Well, that all makes perfect sense, and I think it starts to get to the kind of the core of one of the topics I wanted to get into today, which was kind of the accelerator versus incubator versus corporate venture capital versus strategic investment fund, kind of what the best model is, or better yet, assuming there is no one best model, what the strengths and weaknesses of various models are. And I suppose at an even higher level, what collaboration between startups and incumbents is all about. So in terms of InnoTribe, I mean, thinking about that model, what were the strengths and weaknesses?
InnoTribe was all about educating the community, bringing the community together. And when I talk about community, I mean the industry, with all the constituents. So startups, investors, corporates, and the in-betweenies, like a Swift or like kind of other cooperatives, collaborative processes. So it wasn't so much results-driven, but more about bridging, dialogue, starting conversations, and education. And that served a purpose. I think where InnoTribe ended up not being able to succeed was, like many organizations who are looking at innovation, they don't really understand what the needs are and what the capability is and what they need to do to bridge that. And with InnoTribe, the problem that we had was that we did exciting things, but to the rest of the company, we were seen as a bunch of misfits who were just doing colorful stuff with Post-its and beanbags. And we never really managed to bring the organization on board, to excite them and let them participate in this. We had some little initiatives, but it was not structured. It was not, it just didn't do, we didn't do a good job of doing that.
Yeah, so it sounds like kind of the common theme with a lot of innovation labs at banks or X labs or disruption labs or call them what you want to. But so it sounds like with InnoTribe specifically, the strength on one side was being effectively associated with, sponsored by a large cooperative like Swift that had connections, that had financial resources. But at the same time, that was to an extent a limitation in that it's tough to change culture at a large incumbent. Yeah.
Absolutely. And we can talk about this for longer because this sort of, I think maybe we should revisit this as the conversation progresses. The other problem with InnoTribe was that we didn't really have the remit to change the organizations. We could just open their eyes or knock on their door and be very shouty about things, but then they had to do their own thing, right? Which is very different from our life now, because now we actually talk to the right people within the organizations who remit it is to affect change. InnoTribe's still around. I mean, don't get me wrong. The conference pieces still existed. The competition has morphed slightly, so the showcases are now run mainly in emerging markets, so Latin America and Africa. And there's always been talk, even in my days, about shifting this into something that is challenge-driven. Now, Swift is uniquely positioned to know about some of the challenges that are industry-wide. take any segment of the industry, the securities world has its own challenges, the payments world has its own challenge, KYC across the board, et cetera, et cetera. So now I think from what I hear is that they're looking to be more specific about going to the market and actually finding solutions for problems that a bigger chunk of the community would benefit from. But then if I were to look at them like any other startups, it's all about the execution. So we'll have to wait and see.
Sure. So Startupbootcamp Fintech, by contrast, is an accelerator. You can correct my terminology at any point. How is the Startupbootcamp Fintech model different from what InsurTech is doing?
So first of all, I think we can settle on terminology. We can agree to call it an accelerator, although the term has now been diluted so badly that it has really lost its meaning. People are using all these words their own way. There's variations on a theme. Ultimately, what InsurTech started and what we took in spirit and brought it into what we do with Startupbootcamp is it's an industry innovation program. That's the way I look at it. Because everybody who participates benefits from it, but everybody has its own value proposition. So what Startupbootcamp does is it provides value to the startups, a very specific value to the startups, and we have to talk about this in a lot more detail, I think, and value to the corporates. But it usually is not what people who come into this think they will get out of. Because at the moment, everybody and the mother has an accelerator. Everybody thinks that startups will solve the problems that they have. And it's just, it's one of those things where I can get onto my soapbox and start shouting because it's just not true. Startups in fintech are not the same type of startups that the original accelerator model would have satisfied and serviced. 10 years ago with Y Combinator and the first iteration of Techstars, etc., we were talking about early stage entrepreneurs who needed that extra boost and a structured kind of curriculum through mentoring and introductions to, put their app on the App Store and start selling like hotcakes, or build a game or whatever it is, right? But these are all things that sell in a very different way, where the distribution is different, the go-to-market is different. In fintech, the majority of teams that we see need the industry. They need the industry to validate. They need the industry as technology buyers. They need the industry as collaborators. So therefore, the concept has changed. So therefore, looking at a startup from that venture mentality only no longer works. Mm-hmm. So this is when we started this. We thought we have to go away from that and really focus on industry-specific solutions.
And is that because Startupbootcamp Fintech caters to B2B propositions as opposed to B2C, or is it because Fintech has developed, matured in recent years to focus on more B2B propositions?
I think we can put, to some extent, B2B and B2C into one bucket. It's still, the entrepreneurs need a different type of help, right? Even an early stage entrepreneur who's doing B2C, they still need mentors that understand the space. But also, even though they might not be B2B, they might still need to be regulated. So therefore, again, the process is prolonged. So it's a different story. So the entrepreneurs that come to us do not come to us because they expect that the first thing that they will get out of the program is going to be funding, which is the old model, right? What they want is a validated model and the credibility that allows them to go through the regulatory process, maybe a little bit easier. Or if it's B2B, to have the first introductions with the right people within the banks, etc. Mm-hmm. So we don't focus on one or the other. But if you want to have a conversation about the maturing of fintech, absolutely. When we see the waves of the problems that startups have addressed in that space, it started off with payments. It's all very straightforward, in inverted commas. Then it moved on to alternative financing and lending. And now we're talking about investments. We're talking about a lot more niche solutions for the industry, a lot more esoteric aspects of the business. Last week, NASDAQ ran an experiment on proxy voting on blockchain, right? I mean, we see startups who come to us with that type of product, that type of business, and that's not something we would have seen 5 years ago.
Well, it's interesting too, because I feel like 5 years ago there were college kids basically hacking in garages or dorm rooms and putting out interesting kind of user experience, front-end focused propositions, whereas now, and it's funny in the context of a quote-unquote startup accelerator, you have middle-aged, pudgy around the waist, gray-haired, spectacles-wearing former bankers, former investors, industry people, wearing T-shirts, pitching startups.
You mean like myself?
Not like you.
I always surprise people when I tell them that the average age of our cohort in Fintech or InsurTech is 38, right? So when it comes to kind of bursting some of the assumption bubbles that people make about our space, one of them is that it's not just B2C, it's not just about that kind of quick hockey stick because whatever. The other thing is that it really is usually people from the industry. We rarely see the 20-year-old dudes in T-shirts who built something cool. And if they start doing it very quickly, they realize that it needs to have some gray hair and respectability if it's meant to be regulated, or if they're looking to sell into corporate, right? So absolutely, it's not the cliche. It really isn't. And it's kind of funny when we have our pitching events during the accelerators. The startups are the ones who dress up, and the bankers are the ones who lose the tie because they're doing something cool. So it's a very, very different world.
Well, I think there should be a bit of fashion guidance provided by yourself, no doubt, extremely fashionable guy, to your startups, your cohorts very early on.
To not wear suits?
to wear, for the right types to wear T-shirts and the right types to wear collared shirts.
It's so funny. Little anecdote, a very senior person who used to work for one of the large banks in an innovation-related role ended up leaving the company after 20 odd years in the industry, and ended up joining one of the more successful blockchain startups to be that liaison to the industry, which I thought was a very smart move. And we were sitting in the rainmaking loft in our home because he wanted to update me on his new world, and he comes along with his MacBook and his iPhone, and I sort of made a joke about that. And he looked at me and smiled, but he was also a little bit nervous, and he goes, "Yeah, and it's all in the cloud." And you look at him and you go, you just forget that some of the things that we take for granted now, which is that a lot of what we do is cloud-based, a lot of what we do is mobile and light and connected. And this is still an industry that operates on BlackBerries and authentication tokens and black uniform Windows-operated laptops.
So real quick, can you just describe the Startup Bootcamp FinTech model so we can then get into some of the questioning about strengths and weaknesses?
Startupbootcamp, as an accelerator, operates a traditional model in the sense that we run a cohort-based program, which means the entrepreneurs that we pick into the program have to co-locate in London, Singapore, New York, Mumbai, wherever we are, and stay with us for 3 months. It's a structured curriculum. It is mentor-driven in the sense that we engage a really big group of mentors who help the entrepreneurs. We bring in our own expertise, and we try to get the entrepreneurs that make it into the program to do in 3 months what they would normally do in 12 to 18. Hence the accelerator. We take equity. We take 6% equity from the startups that make it into the program, and that's for the program. That's what they pay for. We give them some pocket money. We give them 15,000 euros cash, irrespective of their stage, their valuation. We don't engage in these conversations. This is really pizza money for the 3 months.
So 50,000 or 15?
1.5. And again, when we have these conversations up front and we sense that the entrepreneurs really rely on that money, chances are that we will not take them into the program. We don't want people to really depend on that. The key thing, and this is probably where we're different from other people providing similar programs, is there's a few. One of them is that all our programs are funded and sponsored by industry players. So in London, we've got 3 banks, a couple of other non-banking financial institutions, a couple of VCs. In Singapore, similar setup. In our InsurTech program, we've got now 16 industry players who all participate, and they all recognize the value of, on the one side, giving something to the entrepreneurs, and on the other side, sitting at the table with potential competitors and actually openly learning from each other's innovation mistakes. And the corporate partners use us as a tool to actually learn how to do innovation. That's really one of the key drivers. What is important is also that the way we attract startups is not just by, hey, we've opened applications, come and apply. With every cycle, be it in London, Singapore, New York, or Mumbai, we just go on a global roadshow where overall now we touch about 45 different cities in the world, where we run one-day events, where we meet the founders in person. They come to us, they pitch. We have a small local mentor group together who sit down and talk to the entrepreneurs. And this is really important to us because it gives us that intimacy and that insight into a little bit the psyche of the founders. Because if they're not open to feedback and if they don't really want to learn and if they're a little bit too confident, then they might not be the right fit for the accelerator. And on average, about 30% of our intake we draw from these global fast track days. But these one-day events that we do are also community building. So we go to cities where nobody's ever been to talk about fintech before. When we did our very first one in Beijing in summer 2014, we had about 10 applications. Not a single one was fintech. Year 2, we had about 100. And there were some really relevant fintech applications. So it's also about generating that kind of the fertile ground for people to recognize that there's an international player who's looking for them. As a result of that, also the majority of startups that make it into a program are actually not from the home city. It's a little bit different in our India program, but that's on purpose, it's by design. We built Mumbai because we wanted to have a program for India. So where we are different, I think it's at global reach. And we usually have between 300 and 400 applications per cycle, and we select 10.
So what are the strengths and weaknesses of that model?
Strengths is that we know what we're talking about. We see ourselves very much as an industry player. And this is definitely very different from anybody else, because everybody else just operates accelerators. Whereas our program fits on the corporate side within a broader innovation engagement spectrum. So we work with the banks and the insurers, and because we run other verticals as well, we work with all these corporations on their innovation needs, and the accelerator kind of satisfies one particular piece. For the entrepreneurs, what is really important is that it's not one bank behind it, it's not one insurer behind it. So it really makes a difference in the quality of the startups that we manage to attract, but also how the entrepreneur ends up getting access to the right level of player to spar with. Weaknesses, I think it would be easy to say there are none, right?
I would push you on that.
We find it increasingly difficult to get founders to commit to the equity. And that's mainly...
I was going to say, because it's effectively like a 250,000 euro valuation if they're giving up 6% equity for 15K.
But that's what I tried to avoid earlier. We don't do 6% for 15K. We get startups into the program who raised a couple of million US. Who come to us because of the access to the corporates, right? It's really not for the cash. And because every time we have a conversation with the founder, we get into this loop of 6% for 15,000 and we have to separate them and say, no, I'd rather you wouldn't look at the cash, to the point where I'm actually quite keen to drop the cash altogether so people don't even look at that. It's really a 6% for the program, but even that, you talk to founders who managed to raise 50K and there's a cockiness to go, why would I give 6% up? And there is a lot of noise, there is a lot of kind of attitude as well that people think that they can raise money really easily, which is a bit of a fallacy, by the way. But from that perspective, we sometimes don't get the best startups. That's why I think that the model has a bit of a weakness, and we're looking at that. The other thing is that because we do attract growth companies, we do attract companies that are post a seed round, maybe about to raise a Series A, and we can add value to them, but because of the shape and the structure of the program, they sort of have to go through some early stage stuff as well, which might not necessarily be relevant. So I think that would be, weaknesses. Where we struggle quite openly is more the noise that we have in the market and people finding it really difficult to filter out the quality. So we lose startups that go to programs that don't take equity, but we know that they also don't give something to the entrepreneurs. We had recently an entrepreneur came to us who we wanted, and they chose to go to one of the competing programs because of the equity piece. And they came to us and said, Nektarios, can you give us some investment advice? And you go, well, you are in an accelerator. Yeah, but they don't talk about investment. And you go, how can you not talk about investment in an accelerator program? Maybe you don't do this in week 1 or 2, but if you have founders who are looking to raise as early, you sit down with them and work through that with them. So there is an element of quality, and we're not particularly good at actually blowing our own trumpet.
So in terms of the corporate sponsors, because I think that's kind of a nice segue into some other engagement models, so corporate venture capital, for instance, how How serious are your corporate sponsors about engaging startups, finding new suppliers, and investing in supporting those companies over the longer term?
Now, this is probably my favorite soapbox subject. The majority of corporates in any industry, but if we stick to financial services and insurance, have no idea what they're doing.
In general, or when it comes to
when it comes to innovation, they have very little awareness about the capability. They have very little awareness about how disjointed their efforts are and how little strategy there is in the way they look at this. And they make these naive assumptions that startups are a uniform animal. And when you sit down with them and you actually start digging and try and figure out, so, okay, why do you want to participate in this program? Sometimes it's purely because of marketing. Sometimes it's because there is this naive assumption that we're going to see a great startup and that might fundamentally move the needle on a particular problem that we have. And we have to tell them to, if this is the way they look at it, might as well just walk away from the conversation now. So I spend about 50% of my time having these conversations because we're permanently building new programs. And it's fascinating to see that there's a lot of Me Too. Well, we want an accelerator because our main competitor has one, or because everybody does something in that space. So we have to be very clear about an accelerator stage startup, which is usually pre-seed stage, which is usually 3-4 people, if you're lucky, who've been around for, 6, 9, 12 months and managed to raise maybe a couple $100,000. They can't even get the foot in the door with the bank, right? Because the procurement processes would normally not allow them. So how is this startup supposed to make a difference to the bank? So the banks have to recognize that they're really naive and that different stages of startups can actually help them with different types of needs that they have as an organization. But that awareness, that recognition is usually not there. The smart ones recognize that they need to play around with the model and experiment, and recognize also that some things will work and some things will fail, and that you just have to revisit things again in the true spirit of innovation, right? Where failure is an essential part of the process. So when I started, if we take InsurTech into account, so I've been in the space now for nearly 7 years, right? So I've had quite a few of these conversations. And the interesting thing is, and this is only I only had this moment of realization about 6 to 9 months ago, where what we do for the corporate partners is R&D. It's pure R&D. Okay, what's the latest in blockchain? Let's have a look at it. And if this is relevant, they do KYC on blockchain. Yeah, and then we have to play around with this, recognizing that it's still very early stage. But talking about R&D in our industry is alien. This is not an industry that actually knows what R&D is. If you're doing retail, maybe you do a bit of kind of customer discovery. But how does R&D work in a corporate bank? How does R&D work in an investment bank other than research on stocks, etc.? It doesn't exist. So trying to instill a mentality of R&D and the necessity of it in this industry is just absolutely frustrating and not particularly rewarding, but little by little, they're getting there. So you take some of the organizations like, I'm not going to mention names, but some of the banks, they have their own fund and they have their own accelerator and they do collaborative accelerators and they do competitions and they do thought leadership, and they're very open about the fact that it's a bit of a stab in the dark, but we have to try all the things in parallel because that's the only way to learn, and we also have to iterate and evolve. And then you have the other organizations at the other end of the spectrum who went, but we're doing innovation, we've got a $200 million fund, and that's the end of that conversation. And that's really frustrating because this organization will never actually understand what's happening, because the only way this makes sense to them is by assuming that other people will fail and they will just buy into the latest technology that is proven and that will solve their problems.
I was going to ask you about your views on the corporate venture capital model. I think you've in part given them there. Do you see successful examples of banks investing money at arm's length in startups in a way that meets the needs of this in-house R&D aspect that you're talking about?
If you look at there's not that many banks who actually do corporate VC at an early stage, right? And the ones that do, they do it sort of in different ways. There are some that do it at arm's length, some that invest off balance sheets. Again, it goes back to not necessarily really knowing what they're doing. And I'm not saying this to be particularly facetious, right? It's really interesting that if you really want to invest in early stage startups and you really want to make strategic investments, first of all, you should ask yourself the question about what is it that I want to achieve, right? Is this like when Citi Venture started, the investments that Citi made was not for Citibank. They were just good investments. So it was a VC that was supposed to make some money, right? And the perspective has changed, right? If you look at something like Santander Ventures or Reinventure in Australia, they have a different mentality now. Slowly, people recognize that if we are investing in startups, maybe it's worth investing in teams that are actually of direct relevance to the bank. But that's a very different investment thesis. It's a very different approach. You have a different horizon. So I think we need to differentiate. Some organizations have spent more time thinking about this than others. It's sort of reflected in many different ways. If you look at some of the corporate VCs that make investments for the fintech fund of the bank, these are people that come from the bank. So these are not necessarily VC people. They might have come from, I don't know, some sort of M&A team or some sort of previous PE experience, which is not a VC game, right? So it's frustrating to listen to this and go, do you actually know what you want out of this? And how does this connect with the rest of the organization's initiatives? And usually it doesn't, which goes back to appetite and capability, this big chasm between the two sides. And it can be on early stage, it can be on later stage, it can be an investment or pilots or whatever it is. Usually people don't understand that they need to develop capability, and that has to come with learning and experiment. I'm frustrated with the noise that has been generated by the corporate VC money without it necessarily being meaningful. And what happens is that you've got these really great entrepreneurs who get super excited because XYZ bank has made an investment into another startup. But then you don't know what happens to that startup beyond the investment, because ideally the founders would want to have access to the bank. They want to have access to the systems. They want to have some inroad. But then procurement, compliance, legal, you name it, is still an obstacle.
That's a nice transition into the broader point around collaboration between incumbents and startups. One of the biggest problems that startups often face in the fintech space, I'm sure it's not limited to fintech, especially around B2B propositions, is the long sales cycle. Mm-hmm. When you're selling into an incumbent organization, maybe it starts with a proof of concept and then it has to work its way not only through confirmation of a fit-for-purpose solution, but also all of the bureaucratic hurdles, red tape, which has time and cost implications for the startup. It sounds like part of the benefit of your corporate sponsors is providing a bit of access, at least putting startups in touch with the right people within organizations to get those conversations rolling. Thinking about collaboration more broadly, what's the state of play? We've kind of moved from a 2008, fintech 1.0, fintech's going to eat the world, complete disruption, obliteration of incumbent organizations, to a phase now in which startups look to effectively sell into, become suppliers of incumbents. Unfortunately, it feels a bit watered down. It feels a bit like settling. I feel like there's so many great opportunities for startups to really do something impactful in financial services. Maybe we'll get there. But how do you view this tension of cooperation versus competition?
I actually don't think that even the most disruptive startups ever really competed with the banks, because if you look at the noisy early stage disruptors, when they were addressing alternative lending through peer-to-peer mechanisms, or if it was about peer-to-peer forex, they were servicing a segment of the customer base that was completely neglected by the banks. So TransferWise is not really taking away a lot of business from the banks, right? In the same way that all the crowdfunding platforms or the lending platforms, whatever it is, really are taking away business from the banks. All these elements are things that the banks don't care that much about. So there was a need. People saw the need, they had a solution, they went for it. And that hasn't gone away. I think what we see now is smart entrepreneurs going, for some of these things, we need the banks. And we can actually help them evolve. And therefore, they're looking more to collaborate. But they don't want to sell out. And this is an assumption that a lot of the banks are making. It's like, oh, well, we'll play with this, and if we like it, we'll buy it. The majority of founders we talk to want to build a business that they want to grow. And they want to grow even further, and they want to scale it, and then we'll go global. So I don't think that disruptive spark has gone away. I think people are just a little bit more realistic about what are the real problems that we're solving. And if I'm a businessman, and if I know that I can solve a problem that the bank has, but they will never be able to solve themselves, but I can give them technology to do that, that's not maybe a bad idea. I think collaboration is also important because there are some genuinely big problems in the industry, and some of them are syndicated problems that you cannot solve with one organization alone. All this blockchain conversation we've been having over the last few years, a lot of it is stuff that the banks need to collaborate because it's a centralized problem, if you like, right? I think it's exciting. We still see the founders who building new banks because the banks are doing a really bad job. Anything related to SMEs is just still, it's a segment that the incumbents have criminally neglected, right? So there's definitely a need still for these players to come into the equation and compete. And when we look at the kind of the initiatives of the regulators in the UK and some of the other more kind of lucid economies, giving them access to regulation so they can compete because it's for the benefit of the customer is important. So I don't think it's as black and white.
What characterizes successful collaboration between startups and incumbents? What's required on both sides?
First of all, and this is part of it, is what we do, right? We help translate. Translation is important for both sides. The banks need to understand that the founders cannot move at the pace of a bank. And the entrepreneurs have to understand that just because they have a great idea doesn't mean that the bank will instantly just jump up and down and do stuff, right? So successful collaboration is a mutual kind of, it's a bit of a zigzag. I come to the bank with a great idea, but I need to prove that the bank can actually interface with it. So the bank needs to kind of give me that validation. From that perspective, they have had some learning, and the more kind of visionary banks recognize that whatever technology I bring to the bank or whatever business model I bring to the bank, they will never be able to replicate in the same way. So I think both sides benefit, and this is where the collaboration really works. In our first year in London, when we started, we had 3 banking partners. One of them I would say was a sort of more advanced stage of innovation capability. And one of them was at a very early stage. And that kind of more conservative organization said to us, look, we're here to learn, and we'll meet great companies, and then we'll introduce them to the core bank. And then it will still has to go its own way. So it would still mean a dozen meetings without any real action until we find the right person, et cetera, et cetera. So it's all about managing expectation with the founders. Whereas the other bank, the more kind of advanced one, they have a dedicated testing environment where they can play around. They have test data. How many banks have actually test data, right? Meaningful, relevant test data. They also have a separate procurement path where they go, okay, we know that we need to change our criteria so you can actually come on board really quickly. And it doesn't take 18 months, it takes 3 months, right? And the good thing about that is that over the 3 years that we had in London now, the more conservative bankers also caught up. So they can actually do these things. They can come out of a 3-month accelerator engagement with a startup and run a meaningful pilot. That's, I think, is a good sign for smart collaboration.
Wow. Well, I mean, that sounds like a lesson that that a vast number of incumbents can learn from. It's certainly one of the limiting factors when it comes to fintech startups trying to engage with incumbents. I mean, you can literally run out of cash and die as you're waiting for a positive response from a willing buyer.
Do you want some more? There's 2 more things in that context that are super important, really. One of them is that in the majority of organizations, nobody is incentivized to do innovation, right? So no business head has part of its remit, and I'm saying no, I'm generalizing, but for a reason, right? The majority of players who lead a business, being head of lending, being head of cards, whatever it is, do not have a remit to do innovation. It always happens within the innovation team. Now, one of the banks we work with, they've got this digital animal in the middle where they are the ones that engage with the ecosystem. And if they see something nice, something relevant that fits with the strategic priorities of the bank, they go then back to the head of lending or head of cards and say, hey, we've seen something cool. Do you want us to run an experiment with it? And if it fails, we know it's learning. But if it works, then you commit to transition this into your business. And this way, they make it relatively easy for the business head to actually buy into it and support it. These things are never smooth, but at least there's this mentality that this is how we should do this, right? Which is very different from, the moment you have budgetary constraints and time constraints, innovation is the first thing that falls off the table, right? The other thing generally is that there's very little linkage between startup engagements on the outside and internal innovation activities and anything to do with culture change and mind change. And what we do with the Startup Bootcamp program is we use this program to bring in people from the bank to actually experience entrepreneurs and learn about a different way of working. Because that also really changes the way they look at their own work and their own products and their own processes. And that excitement is something that a smart organization can build on. And we had the CEO of one of our partners come in our first year, and we sat down, and it was amazing to have half an hour kind of exclusive access to this gentleman. And he was bombarding me with questions. He was super switched on. At the end, he said to me, okay, ask me one question. I said, okay, what keeps you awake at night? And it looks at me and goes, culture change. How do I bring my organization onto the same kind of perspective that I have, and how can I make it possible for them to actually do these things if they get it, right? And that's something that you can name any bank in the world. I bet you they're struggling because they haven't figured it out.
We talked mostly about the fintech track that you guys run. You also have an InsureTech track, which you mentioned. How's that going?
InsureTech's interesting. Interesting also because fintech's been around for a while. Some people talk about us having reached peak fintech. InsureTech is definitely an industry that needs innovation, probably even more than the financial industry. It's a more rigid industry under very different pressures. When we launched InsureTech in the summer of 2015, we launched with 5 partners, and now we've got 16. So there's a real thirst for that stuff. But at the same time, on the supply side, we have fewer startups that self-identify as InsurTech startups. So the way we approach it is we go out and we talk to the big data companies and cybersecurity companies and alert them to the fact that there's an insurance world out there that is just desperate to meet them. So there is a lot of desire for innovation on the industry side, recognizing that they don't need to repeat the mistakes that the financial industry has made. But at the same time, finding great teams is a little bit harder. We are looking to grow our programs. We're looking at multiple locations at the moment to launch an InsurTech program. And it's wonderful to see how it resonates with the industry. It's going to be interesting to figure out how we will continue attracting the best entrepreneurs into the program.
And in terms of the regions that you guys are present in, I think you've mentioned most of them already. Are there, thinking over the next handful of years, do you hope to roll out into new geographies or new tracks within FinTech and InsurTech? We
started Startup Bootcamp FinTech with this ambition to build a global network of connected nodes, right? So London, Singapore, New York as the big hubs, and then regional or local hubs that make sense. So Mumbai came out of the recognition that there's a ridiculous number of quality startups that are looking to service the domestic market. That's why we launched India. We have conversations in about a handful of regions still in Europe, globally. It would be taken away the surprise, would it? But no, we were definitely keen to launch at least another 3 to 4 fintech programs. Some of the programs we're building do not necessarily justify a dedicated InsurTech stream. So we're building a fintech and InsurTech program in one. And even in India, we have an insurance partner on board with ICICI Lombard. So yes, absolutely. And it's going to be a watch this space. We were about to announce our next foray in the next, hopefully, next 4 to 6 weeks. But it's also that we're also looking to evolve the way we run the program. So there's a variety of different things happening at the same time. In the context of what we do, we also have a fintech and cybersecurity program in Amsterdam. So it's become a little bit more specific about what we look at. And regulation becomes increasingly important, right? We're figuring out what our proposition has to be in that space. RegTech is even smaller as a community. And RegTech as a term is something that is a little bit vague, because is it about providing technology that helps the regulators, or is it about technology that helps the incumbents with the regulatory requirements? So it's a broad church, but the startups that see themselves as RegTech startups are even smaller, the number, right? So, but I think we have to do a little bit more ecosystem development work there, and that's what we're focusing at the moment. So we are going to have meetups around the world on that specific subject, but it falls within the bigger bucket of our world that helps the industry, right?
Nektarios, what's the best way for people to find out more about your work and connect with you directly?
Well, we're quite noisy, right? So if you haven't heard of Startup Bootcamp, how dare you? No, it's startupbootcamp.org. That's our domain. We have a very active Twitter presence. Startup Bootcamp Fintech in particular, we also have a good LinkedIn presence. We've got offices in London, Singapore, New York, and Mumbai at the moment, where the teams usually organize a fair amount of community events. I'm Nektarios Liolios on Twitter. You can always hit me up there. I think that's the main channels. I think they should cover it.
Great. Well, Nektarios Liolios, without a doubt, one of the most knowledgeable, best dressed, and all around coolest guys in fintech. Thank you very much for joining us today.
Thank you, Will. It's been a pleasure. Thanks.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.